Hello, I'm Rodney Jones with the Agricultural Economics Department at Oklahoma State University, and in this session of the Farm Transitions Workbook video series, we're going to talk briefly about where do you stand financially. That's obviously an important consideration when we're thinking about a family business transition, is to take a good hard look at the finances of the operation. In the next video, we're actually going to talk about looking at the finances in a forward-looking fashion, doing some financial planning. Here we're going to take a look at the finances of the existing operation. So we're going to talk about measuring farm financial performance and position. There are 5 categories, 5 long-established categories of financial measurement. 2 of them pertain to what we call financial position, the financial status of the farm. Those 2 categories of measures are liquidity and solvency. I will talk a little more in detail in just a few minutes about what those terms mean. The other 3 categories of financial measures fall into the under the realm of financial performance. How is the business doing? Not where does the business stand, but how is the business doing? Those measures, those categories of measures, we call profitability, repayment capacity, and financial efficiency. Most of those terms are somewhat self-explanatory and may be very familiar to most of you watching this video series, but I'm going to go into just a little bit more detail on each of those as we go through the video. So we're going to help answer the questions with this financial evaluation. Am I profitable? Do I have the resource base that will be needed as we undertake this transition process? More specifically, or more day-to-day, will we be able to repay our obligations? Am I, or is the business doing a good job? We'll talk about some measures of what we're talking about there. Will the current operation achieve the objectives and goals? We talked about that in the previous session. We'll talk about it a little more in some of the other video clips. Will the current operation achieve what the various stakeholders have in mind for that operation to achieve? Those are the kinds of questions that our financial evaluation is going to help us answer. So, you might ask, well, where do we get the information to start with? Where can we start this financial evaluation process? We're going to start it from the 3 basic financial statements. We're going to start looking at the balance sheet. We actually probably need a beginning and ending balance sheet. Usually those are done at the end of a particular fiscal year. For most farms and ranches, that's the end of the calendar year. Wouldn't have to be the case. So we're going to need one for last year and one for this year, or any 2 sequential balance sheets from recent years is going to give us a lot of help in that regard. The balance sheet is going to tell us the value of the assets that we have to work with, the amount of debt that we owe against those assets, that's our liabilities, and then what's left over in between, which is our net worth or our equity. Most of you probably are familiar with those terms. We are also going to make use of what we call an income statement. That's going to be a portrayal of revenues and expenses. Revenues, value of something produced, expenses, cost of producing that over an accounting period, that accounting year that we talked about earlier, the fiscal year of the business. Normally in agriculture, that's going to coincide with the calendar year. And then the difference, of course, between the revenues and the expenses is going to be profit, and we all like to talk about profit in the business world. The third financial statement that we're going to draw some information from is the cash flow statement. We're going to look at a statement that gives us a reflection of cash coming into the business and cash going out of the business. Now, there may be a significant difference between say, for example, cash inflows and the revenues that we referred to when we talked about the income statement, or cash outflows and expenses that we talked about when we talked about the income statement. And we'll talk about those differences, and they're very important differences as this discussion proceeds. So what's a balance sheet? A balance sheet is a systematic organization, usually laid out either top to bottom or side by side, a systematic organization of everything owned by the business and everything owed by the business at a particular point in time. The balance sheet is going to show us financial position, and it's also going to tell us something about the term structure of the assets and the debts. We'll talk about that briefly here in just a minute. I like to think of the balance sheet as like a picture, like a snapshot that you might take on a cell phone, or if somebody were to fly over your farming operation in an airplane and take a picture at one point in time, or to use a drone to fly over and get a picture of your farming operation at one point in time. That balance sheet should capture the value of everything that gets caught in that picture on that day. And then, of course, we would have debts and other obligations associated with those things that are in that picture as well. And the balance sheet is going to reflect all of that. Assets, anything owned by the business or owed to the business. If you have done some custom work, for example, for a neighbor in December and you haven't been paid for it yet, at the time you put the balance sheet together, but you fully expect to be paid for it, then that would certainly be an asset. It would be something owed to the business, an account receivable, if you like to think of it that way. Liabilities, any debts owed by the business, and this could be operating loans, it could be accounts payable at the co-op, it could be machinery loans, it could be real estate loans, breeding livestock loans. I think you probably have a pretty good picture of what liabilities are. And of course, that accounting relationship that we get off of the balance sheet, assets minus liabilities equals net worth, or equity is another term for net worth that you might hear or might see. Measures of financial position that we might get off the balance sheet. We talked about that term solvency. That's a measure of the amount of liabilities relative to the net worth, or it basically is what the business would be worth if it were sold out and all the debts were paid off on that particular day. We can measure that in absolute terms, the absolute level of net worth, the absolute value of the equity in the business, but more commonly in the business world and in agriculture in particular, we like to use a ratio. We like to use something like the debt to asset ratio, the total value of all the debts divided by the total value of all the assets, which puts it on a scale independent framework. In other words, we can compare businesses of various sizes based on the debt to asset ratio, and we don't get a distorted value. We get a relative comparison there when we do that. So solvency, normally measured by something like the debt to asset ratio or one of the associated measures. The other thing that we can get directly off of a balance sheet is a liquidity measure, the ability of the business to pay bills as they come due. Can the business operate in the short run, usually in the context of the next foreseeable year? We usually measure liquidity using something like the current ratio. That would be by far the most common measure of liquidity used by farm and ranch businesses. Value of current assets divided by the value of current liabilities. Now, what's a current asset? A current asset would be anything that is cash or would reasonably be expected to be converted to cash within the next year. That belongs on the balance sheet in what we call the current assets section of the balance sheet. And we have some examples of that available in the workbook materials for you to look at, and in some of the other supplemental materials on the website. But anything that's cash or would reasonably be expected to be converted to cash within the next year would be considered a current asset. So for example, if you had grain that you had produced and you still had it in inventory at the grain elevator or in the bin at the farm, we would reasonably expect in the normal course of business to sell that grain within a year. That would certainly be a current asset. Or stocker cattle out on wheat pasture, for example, would be a current asset. Current liabilities, similarly, bills that are due or bills that need to be paid within the next year would be a current liability. And all of those things belong in the current liabilities section of the balance sheet, and we sum those up. We add up all of the current assets, divide that by the sum of all the current liabilities, and we get the current ratio. So we have some standards, if you will, to give us an indication of how healthy a business might be at any point in time, and here's just a few. There are a number of these measures that have been recommended by various entities such as the Farm Financial Standards Task Force. A common solvency measure, as we talked about, would be the debt to asset ratio, and under normal conditions you would, of course a lower number here is better. You would expect a number under 40% to be a relatively low stress, low financial stress situation. A higher number and a really high number, for example, 70% or more of the total assets that are managed by that business are owned by somebody else in the form of a debt contribution to that business. That might be considered more of a high stress situation. By the same token, we have some benchmark standards, and not that these are set in stone by any stretch of the imagination, for liquidity measures, and here's just an example for that current ratio. Here, the bigger the number, the better, right? Because we are using a ratio that is the current assets divided by the current farm liabilities. So the higher that number, the more comfortable the farm would be in thinking that it certainly had the ability to cover those short-term obligations. Kind of a broad benchmark illustrated here would be something 2 or larger would be considered fairly low stress, a fairly comfortable situation. Anything under 1, of course, indicates that you have more liabilities coming due within the next year than you have assets that are either cash or expected to be converted to cash to pay those liabilities. So certainly the higher number, the better here, the better financial position and a better ability to address those short-term needs. These are just some examples of some benchmarks. Another thing to consider when we're thinking about this balance sheet is how we value those assets on the balance sheet. There are 2 widely accepted approaches. One is the cost approach. That's the initial cost of the asset plus any improvements that we've put into that asset, the value of any improvements, like a new engine in a tractor, for example, long-term improvements, or a new building on a piece of ground, for example, and then subtract off actual depreciation, actual loss in value of that asset, and we end up with the modified cost dollar value, and that's what we put on the balance sheet, or those are the numbers that we aggregate to put on the balance sheet in any category that we might be looking at. The general business world, those businesses that conform to generally accepted accounting practices, they actually prefer a cost basis balance sheet. In agriculture, it is much more common for us to rely on what we call a market value balance sheet. The assets are valued on that balance sheet at an estimate of what they would currently sell for. So for example, as we have seen a ramping up of agricultural real estate values in Oklahoma and in fact across the country, most farms and ranches have periodically ratcheted up the value of the land on their balance sheet, ratcheted up their asset values, and that gives us a pretty fair representation of collateral value and is much more useful to the lending community, for example, in the ag sector. There are some cautions. We want to be careful about not overshooting the mark, so on and so forth. Both approaches are acceptable and in fact, many analysts suggest that people put together what's called a two-column balance sheet where they actually list the asset values both in terms of their modified cost value as well as their market value. So those are just a few things to think about. A couple tips in preparing. A typical farming operation looks a lot different in June than it does in December. And I really don't care where you're at in the United States. That's true for most farming operations that we deal with in this country. Here in Oklahoma, for example, a wheat stocker cattle production operation in June is going to have either just harvested some wheat or have some wheat ready to harvest. Probably won't have any wheat pasture stocker cattle on the place. Whereas in January, they've got some wheat in the ground, but it's a long ways from being ready to harvest. But they perhaps have thousands and thousands of dollars worth of stocker cattle around. And my point is, a farm looks a lot different at different times of the year. So in order to make a year-to-year comparison to try to determine whether we've made any financial progress, for example, it's very important that we prepare a balance sheet at the same time every year for comparison. Focus on completeness. We're counting things and we're putting value on those things. Focus on accuracy and maybe be a little bit conservative in those values if you're doing a market value balance sheet. And again, if you are doing a market value balance sheet, which is very common in agriculture, focus on liquidation value. Does the bottom line that you're getting when you put that balance sheet together reflect what would be left over if you sold the business out and paid off all the bills? Not that I'm suggesting that you do that, but you should be pretty comfortable with that number, that it fairly accurately reflects a liquidation value, if you will. The income statement is a summary of revenues and expenses over a period of time. Important point, revenues and expenses are not the same as cash inflows and cash outflows. I believe I mentioned that once already. You'll probably hear me mention it again because it is the most important consideration when putting together an income statement. The income statement, the analogy here would be if the balance sheet is a snapshot, a one-time picture in time, the income statement is the Gone with the Wind between two balance sheets. It's the whole story, it's the motion picture that goes between the two balance sheets that represent the bookends, the beginning of the fiscal year and the end of the fiscal year, and it tells the whole story. It tells what happened in that business between those two balance sheets. I like to call the income statement the exciting financial statement. Now, my students in class here on campus kind of break out in laughter when I say there is something, any such thing as an exciting financial statement. But what I mean by that is, as business managers, we should get excited about this thing called profit. I don't think we need to apologize for that. I think that's what we're in business for. The other thing that we get excited about in agriculture is producing stuff. So we've got two things to get excited about in the income statement. Number one, it represents what we produced, and we all get excited about being good producers. The income statement represents the value of what we produced, and it tells us whether we made money, whether we made profit, and how much profit we made. Many different measures can be derived from the income statement to help explain how much money we made. Probably the most common one and the most universal one would be rate of return on farm assets. And we calculate that based on net farm income from operations. That would be the revenues minus the expenses. We get that straight off that income statement. We're going to add back in interest expenses, and I don't have the time right here today to explain why we do that, but just take my word for it. We add back in paid interest expenses, and perhaps we subtract off a charge for unpaid operator labor and management, depending on the type of entity that we have set up and how we account for that in our accounting system, most commonly in a sole proprietorship where we're not writing people checks for that. We do subtract off some value for that, and then we divide that by the average total farm asset value. Here I've got on the slide that we're going to divide that by the average of the beginning and ending farm asset values. You could pick either beginning or ending, and you probably wouldn't be off too much. So that gives us a measure, rate of return on farm assets. It's a return on investment number. It's a scale independent number. It's a ratio. We can compare return on assets for a small farm versus a large farm, and we're comparing apples to apples. We have some benchmarks here, the way I've outlined that we calculate that. A good rate of return on assets would be anything above 5%. We certainly have farms and ranches that are doing well better than that. Maybe a little bit more of a stressful situation is if we consistently calculate that number year in and year out, and we end up with a number that's less than 1% or even negative. So those would be some benchmarks to shoot for there. Tips for preparing the income statement. Don't forget those inventory adjustments. And by that I mean if we produced something this year and did not sell it, we have to account for the fact that we have built up inventory. We want that income statement to represent the value of production. By the same token, if we produced something last year and sold it this year, we have to make sure that we adjust that cash sales number to reflect the fact that not everything we sold this year was produced this year. We want this income statement to capture the value of what we produced this year. Have a lot more details on how to do that in the resources on the website. So again, remember, revenue and expenses can be much different than cash inflow and cash outflow. So what's a cash flow? A cash flow is a summary of cash inflows and cash outflows for a given period of time. Timing is the key here. We do cash flows typically in agriculture on a monthly basis, a quarterly basis, or certainly at least on an annual basis, depending on the needs of the specific operation. That cash flow instrument is the instrument that is most commonly used both as a historical instrument, a cash flow statement, and as a budgeting instrument, a forward-looking instrument. So if we call it a cash flow statement, that means we're using it to evaluate historical financial performance. If we use that term in the context of a budget, that means we're trying to project cash flows for the future. Very useful instrument, a very similar instrument used for both purposes. Tips for preparing, again, it's all about timing. It's all about helping to plan for periods of cash shortfalls, for help planning to schedule principal and interest payments. Remember that repayment capacity category of measuring financial performance. This is where we get that information. It's just a checkbook register. And the forward-looking document would be a forward-looking projection of the checkbook register. Where's the cash coming from? When is it coming in? And when do we need cash to address some of these financial needs? The cash flow statement does not include non-cash items like depreciation that are in fact included on the income statement. The cash flow statement doesn't capture those inventory changes that I referenced earlier. The cash flow statement may not reflect book value gains or losses on capital assets, those kinds of things. The income statement, by the same token, does not include capital sales and contributed capital. Say if you're an entity and some business partner puts some money into your business, that's not going to be reflected on the income statement or shouldn't be reflected on the income statement. The income statement should not reflect principal payments. Remember, we're trying to capture revenues and expenses, value of production, cost of producing. Principal payments would be a double counting of those costs of production because we've already accounted for most of those things in terms of depreciation and other entries on the income statement. The income statement reflects business income and expenses, so family living expenses do not belong there. Financial efficiency. Can I convert inputs to output as efficiently as I should be able to? That translates directly into profitability. Some very common financial efficiency measures that we like to use would be something like the income expense ratio. That would be interest expense divided by gross farm income or gross farm revenue. And again, there's some benchmarks out there. If that thing gets up above 20%, that might be a red flag. Another one that I like to use, very commonly used in agriculture and in other businesses, is the asset turnover ratio. That's gross farm revenue, gross farm income divided by the value of the farm asset base. In agriculture, we consider anything above 40% to be a good asset turnover ratio. Anything below about 20% probably means that you have too many dollars worth of assets and or you're not generating enough revenue using those assets. So it's a very direct measure of the efficiency of the use of the asset base that you have at your disposal. Many farm analysts will recommend that you evaluate any proposed capital investment on the basis of what will it do to my asset turnover ratio. So it's a very important measure to look at. So, kind of to sum up here, how do you do financial analysis? You prepare financial statements. You choose at least one measure from each of the 5 categories: solvency, liquidity, profitability, efficiency, and debt repayment capacity. And we have numerous additional measures, in addition to the ones that I've talked about in this video clip, available in the resources section and in the workbook that's available on the website. You use that information to look at trends. You use that information to compare yourself to benchmarks, either benchmarks that you've set for yourself, your own budgeted standards, or industry benchmarks, competitive firms, comparative farms, recommendations from ag professionals out there in the industry. Business financial analysis is about determining the cold hard facts, zeroing in on the information, comparing that information to benchmarks as I just mentioned, providing insight into what you're good at, what you're not good at, direction for maximizing the returns to those owned resources that you're managing, and being able to document and obtain credit, which may or may not be very important in the transition process. So, as you think about bringing another generation or another stakeholder set into your operation, both parties, both generations, need to do a good solid financial analysis using the balance sheet, the income statement, the cash flow, study financial trends, study historical financial performance, and prepare financial plans, which is the topic of the next video in this series, as this operation moves to the future. More information, more resources available on that agecon.okstate.edu Farm Transitions website. I'm Rodney Jones, and thank you again for your participation in this video series.